Okay, we're going to do a quick analysis of the cost of ownership versus the cost of renting the same exact property. It's a financial analysis, so it's not going to take into consideration the intangible benefits of owning a house or the intangible benefits of renting versus owning. It's just a dollar versus dollar comparison. And you don't have to be an Excel geek to do this analysis. All you have to know is how to open up an Excel file. Obviously, you got to have Excel on your computer. And then once it's open, all we're going to do is input. It's a plug and play document. So we're just going to input in these gray fields the information on and assumptions we're going to make about owning the property and what the rent cost is. And then the calculator will do everything else for us with a conclusion at the very end where we will see the word own or the word rent highlighted in green, depending on which one makes more financial sense. So let's start out in the MLS with a particular property, one in an area that I'm very familiar with. We're going to take this house here. It's a $315,000 single family home. And I'm going to open up the detailed sheet here. You don't have to have this level of detail on the property. You can just make some estimations and you'll still get a pretty accurate reading on the sheet. But we're going to take from the MLS detail sheet here the purchase price of $315,000. We're going to take the property tax rate of $49.47. We're just going to call that $49.50. And then if we scroll down here, we have the HOA cost of $305 per quarter. So we'll translate that to about $100 per month. Okay, so now we're going to jump over to the calculator and put some of these inputs in. To do this, it's really simple. Just click on the gray field, put in your number, hit enter, and it will automatically go to the next field. Or you can just use your clicker and click on the field that you want to change or adjust. So in this case, the home price, we have $315,000. Closing costs are going to calculate automatically at about 2% of the home price because we're assuming we're going to have some loan costs in there as well. On initial repair costs, this will not factor into your carry costs on the house. What this is just going to do is show us between that number, our closing costs, and our down payment, how much cash we needed to come out of pocket to get into this house. Because that's obviously consideration. On the rent side, we don't have as big a cash outlay. The appreciation rate on the house is going to be the biggest factor that impacts our bottom line analysis here. So if we assume that the property values are going to go up pretty aggressively, that's going to be a huge credit toward the cost of ownership. If we don't think there's going to be appreciation or maybe even suspect the values are going to go down, then you can use a negative number in here as well. We're going to use, just for simplicity's sake, the national historic average of about 3 to 4% per year. So I'm just going to put in 3.5% here. The tax bracket or your tax rate is something that we're going to help you with on this sheet. If you don't know what your tax bracket is or your tax rate is, just go to the tab on the bottom here. It says 2015 taxes. Click on that and it'll show you what the tax brackets were for 2015. So we're going to assume we're a single person and we make between $91,000 and $189,000 a year. That's our adjusted gross income. That means we're in a 28% tax rate. And then the standard deduction for someone who is single is $6,300. So we're just going to assume that that is our case. And under tax bracket, we're going to put in the 28%. We are taking the standard deduction, meaning we don't have some kind of business or something where we get to itemize our taxes. And our standard deduction is going to be $6,300. That means, by the way, that we don't get to take advantage of the tax write-off on the property. Our standard deduction at the end of the year is going to give us more of a credit than the interest write-off on our mortgage payments at the end of the year. For the down payment, we're going to use a pretty typical 10% down. In some cases, you'll get in for less money out of pocket than that. In some cases, it'll be more, especially if you want to avoid mortgage insurance. But if you put less than 20% down, you will see the sheet calculate the mortgage insurance. On loan term, that's going to be the amount of years that your loan is. Most people are doing 30-year mortgages, so we'll put that in there. The interest rate for your loan is going to be based on obviously your credit and your financial wherewithal, but we're going to put in here a good rate today, which is about 3.75. For those of you that are too young to know, that is ridiculously low and will not last. So maybe one consideration towards the ownership side is how cheap money is today and how low you can lock in a 30-year mortgage. The mortgage insurance rate is going to be 0.5%, which means basically your mortgage insurance is going to be calculated at about 0.5% of your total loan amount. The annual property tax in this particular case was $49.50 per year. The insurance on this house, I'm going to estimate at about $1,800 per year. Our HOA fee on this house is going to be $100 per month. Keep in mind that if you're in a townhome or a condo, you're going to have a much higher HOA or condo fee. I've seen them as low as $200, as high as $800-900 per month. And that's going to play against owning the house. The maintenance budget is what we are estimating the cost of just general upkeep on owning a property is going to be. So in this case, we have a 2-story single-family house. It's about 2,600 square feet. I'd guess that we're going to spend at least $150 a month maintaining that property, but since this calculates on an annual basis, we're going to put in here $1,800 per year. Now this next field, the comparable monthly rent, is the only field that we have to put in for rental costs. Everything else that we've put in here is going to help us calculate our true cost of ownership, and we're not accounting for utilities because we'd have to pay that regardless if we rented or we own that house. On this particular house, I know that the rents are going to be about $1,900 per month. So now after we put that in, you see automatically down here under conclusion, without breaking this down, it says that it's financially better to own that property than it is to rent it. So let's break that down. We have a loan amount of about $283,000 with a 10% down payment. Our mortgage payment with just principal and interest is $1,313 a month. Our mortgage insurance calculated at $118 per month. Our property insurance and our property tax is going to be collected by the lender in escrow on a monthly basis. So that translates to $150 on the insurance, $413 on the property tax. Our HOA fee is $100, and then the estimated maintenance cost on a monthly basis is about $150 a month. So our total ownership cost is $2,244 per month. So let's just call that $2,250. So it costs us $2,250 to own the house, and we can rent it for $1,900 per month. Yet our conclusion, our financial conclusion, said it made more sense to own the house, even though here it's showing that it's $350 more per month to own the house. And that's because we're going to give us some credits here. So one of the big credits that offset the cost of ownership is our appreciation rate. In this case, because we put in over here the appreciation rate of 3.5%, it means that that house goes up about $11,000 in value just that first year. So if we offset our carry costs by $11,000, and then we also offset it by $5,200, which is our equity that we built in the house by paying the mortgage down that year, which, by the way, if you want to look at the amortization schedule, you just click on this bottom tab here, and that will show you a breakdown of what total interest and what total principal you paid down on that first year. And you can see here equity is $5,200, and the interest that first year, if you were to itemize on your taxes, and maybe you were in a high income tax bracket, then this will be more relevant for you. But since we took the standard deduction, interest doesn't apply. So we'll go back to the summary tab here, and it says that the loan equity that first year again is $5,200. So if we paid down our mortgage $5,200 and we had $11,000 in growth on the house, the value of the property, then we have a credit of $16,000 that we can apply against our total cost of ownership. So the end result here is that the annual net ownership costs, that's our carry costs on a monthly basis minus the benefit of appreciation minus the benefit of us paying down the loan, is $10,600 net cost of ownership, and the cost to rent that property, which is $1,900 a month times 12 months, is just under $23,000. So in this particular case, based on these assumptions and inputs, it makes more sense to own the house than it does to rent it. Now, interestingly, if we go back up here and we can just change some of these inputs, if we find out that the rent on the property is a little bit lower, let's say $1,800, because we're fine-tuning the deal here, and we find out that, you know what, there are some things happening on the geopolitical front, maybe globally or even locally, like a lot of jobs leaving the area, that isn't going to warrant an appreciation rate of 3.5%. Let's just make no assumptions about appreciation. We put that to 0. Then what happens here is it flips over to rent being financially better than it does to own the house. Then, of course, there are also the intangibles of, I'm not very domestic. I don't like mowing lawns and fixing things. I like picking up the phone, calling the property manager, having it done, and not wasting my time on it. So Now I'm going to be heavily weighted towards renting the house versus owning the house in this particular case. And so we can adjust the form with these inputs here, make all kinds of assumptions. It'll calculate automatically. We'll see this green signal shift from owning versus renting depending on those inputs. Another very important consideration is the cash out of pocket. Now, I don't have this kind of glaring in your face over here on the right, but in this particular house, we have to put down $31,500. That's our down payment on that particular property. Now, one question we have to ask is, if you're an investor and you have other ways to make $31,000 work for you that will outpace the appreciation rate that we put in on this property, then it maybe makes more sense for you to have that money working for you more elsewhere than what it's doing for you stuck in this house. Or it may just mean that, you know what, since I can get a better rate of return than what I think the house is going to go up in value, I will let the bank at this cheap cost of money to carry as much of the house as possible. And even if I can afford to put more down, I'll let the bank carry more of that and give them the risk, then absorb it myself, and I can do more with the cash. So that completes our comparison between owning a property versus renting one. Hopefully this was helpful to you. Go ahead and use this document and play with it a little bit. Let me know what your feedback is. Let me know if it was helpful. And again, it's one that I just created and started testing. So if you find something that's wrong with it or it calculates something inaccurately, let me know and I'll adjust it accordingly. Thanks a lot for your time. Talk to you soon.